Welcome back to Am I Catching a Falling Knife? The podcast where we sift through the market's recent dips to figure out if there's an opportunity lurking beneath the surface. I'm your host, Dave, and today we're putting a spotlight on a fascinating company that's seen a bit of a tumble recently, Honeywell, ticker HON. With a minus 5.19% drop over the last 10 days, it certainly fits the bill of a potential falling knife. So let's dive in and see what's going on. All right, folks, let's dive into Honeywell, ticker HON, a stock that has seen a pretty significant dip of 5.19% over the last 10 days. Is this a falling knife we should be wary of, or a golden opportunity? Let's unpack it. So, what's the story here? Well, the market is buzzing about something quite interesting. Despite Honeywell actually beating their Q2 2025 revenue and EPS forecasts and even raising their full-year guidance, the stock still took a hit. Why? Because concerns about contracting operating margins and a decline in free cash flow overshadowed all that good news. It seems investors are more focused on profitability and cash generation trends than headline beats right now. But before we dive deeper into that market reaction, who is Honeywell? They are a diversified technology and manufacturing giant operating across various sectors. Think commercial and consumer products, engineering services, and aerospace systems. They're strategically focused on big megatrends like automation, the future of aviation, and energy transition. And they're actively optimizing their portfolio, even planning to separate their automation and aerospace technologies businesses into independent companies. Financially, they're big, with a latest annual revenue of nearly $40 billion, trailing 12-month free cash flow around $5.06 billion, and a gross margin of about 38.08%. Now, let's get into the numbers. So how did we get to that estimated impact number, and why did the market react the way it did? Let's break it down step by step. First, as we mentioned, the market narrative highlighted that even though HON beat earnings and raised guidance, the stock declined because of those contracting operating margins and declining free cash flow. This tells us the market is clearly prioritizing these negative profitability and cash flow trends, seeing them as significant enough to eclipse otherwise positive news, which implies a potential deterioration in the outlook for future earnings quality or growth rates. Second, let's talk about those contracting operating margins. This directly reduces profitability. With Honeywell's gross margin sitting at a healthy 38.08%, a decline in operating margins means less of each revenue dollar is translating into actual profit. While the specifics of the contraction weren't spelled out, a typical concern might mean a 0.5% to 1.5% percentage point reduction in the operating margin. Third, to put that into perspective, if we assume, for example, that Honeywell's operating margin was around 15% of revenue, a mere 1 percentage point contraction, say from 15% down to 14%, would actually represent a roughly 6.7% reduction in operating income. And guess what? That directly flows down to earnings per share. This is why small margin shifts can have a big impact. Fourth, the declining free cash flow, which is about $5.06 billion for the trailing 12 months, is another red flag. This signals potential operational inefficiencies or an increase in working capital needs, which are often correlated with lower earnings quality and put pressure on future profitability. Less free cash means less money for dividends, buybacks, or debt reduction. Finally, even though Honeywell raised their full-year guidance, that stock decline we're seeing suggests that the anticipated rate of earnings growth for upcoming quarters, like Q3 2025, might be slower, or that the absolute earnings could be lower than what the market would have expected without these margin and cash flow concerns. Considering how these issues overshadowed the good news, we estimate a moderate negative impact reflecting these profitability pressures. Specifically, we've estimated a minus 3% impact on upcoming quarterly earnings, representing a dampening of those growth expectations or a slight sequential decline compared to prior market optimism. Now, keep in mind there's some ambiguity here, and our confidence interval for this impact ranges from minus 6% to 0%. That wide range is because we don't have exact quantitative details on how much those operating margins are contracting or how much free cash flow is declining. So, what does this all mean for Honeywell's fair value? The stock is currently trading around $224.48. To get a fair value, I ran a discounted cash flow, or DCF model, using some standard assumptions. We're looking at a 5-year earnings per share growth rate of about 7.7%, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Based on these assumptions, our base case fair value came out to around $160.22. But once we apply our narrative's estimated minus 3% impact due to those margin and cash flow concerns, that fair value adjusts down to roughly $150.61. This indicates that at its current price, the stock is trading significantly above what our model suggests its fair value should be, especially when factoring in those profitability concerns. So, if we consider this a potential falling knife, where might we look to catch it? Based on our analysis, some potential custom buy levels, where we might start to consider if this knife is worth reaching for, are around $150, then deeper at $142, and a more conservative level at $126. And that wraps up our look at Honeywell, HON, today. Remember, folks, this is not financial advice, just an analysis to help you think through these situations. Always do your own research, consult with a financial professional, and make decisions that align with your own financial goals and risk tolerance. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.